Hello, welcome to FinTech Diary. The world of FinTech is evolving constantly, and we at FinTech Diary try to map these trends for you. My name is Amol Dethe, and my guest for this chapter is Sandeep Patil, partner and head of Asia, QED Investors. In the last 15 years of his career, Sandeep has worked with an equity firm Actis Capital. Then he worked at McKinsey. After that, he took a senior leadership position at Flipkart. And then he headed Truecaller as MD and CEO. QED is a fintech focused venture capital firm which has 25 unicorns in its profile globally. In India, QED has invested in fintechs like Jupiter, Refine, Upswing, FPL Tech, OneSource, and many others. Sandeep, glad to have you.
Very happy to be here. Thank you so much for having me.
Sure. So, Sandeep, right now I'm in Delhi and it's very hot. When I came to Delhi, it was raining in Mumbai because it's a monsoon time. Why I'm saying this is I want you to tell us whether funding winter is still there or the season has changed.
So, staying with your weather theme, the funding winter is a bit like weather in London right now, where
Okay.
this hour can be sunny and the next hour can be rainy. And it's overall much colder than it's supposed to be.
Mhm.
So I think we are in a funding winter. It has been on at a global level for, I would say, almost a year and a half, if not a bit longer. In India, probably more over a year and quarter, I would say. Till April last year, things were pretty fine, but then things started going into chill. So we are in the midst of it. It's driven by sort of what has been happening in the private and public markets. Public markets in the US in particular have started recovering. So that should mean better times to come, but who knows? Just yesterday, Fed was announcing their intention to do another rate hike, and that would slow down things again. So yeah, I think the depth of winter seems to be a bit behind us, but I think we are still in very volatile weather, I would say.
Okay. Noted your points, Sandeep. I'm getting a mixed reactions from specifically the investors because I think investors are also looking at fintechs or startups according to their segment or the profile they're operating in. Few of them are investing heavily because they are specifically into the early stage investments. But I
Hmm.
think the mid or the senior level are facing a lot of problems. Uh, so Sandeep, I will obviously learn more about funding winter in some more time from you. But please help me understand how has been QED doing in terms of investments? What kinds of fintechs are you investing in? How are you evaluating the companies? How many companies do you have specifically in India in your profile right now?
Yeah. So look, let me talk about QED first, and then we can go into the India story. So we
Right.
started in 2007.
Hmm.
We are right now investing out of our seventh fund, which is $1,050,000,000. We closed it in end of 2021, September 2021. So kind of fairly big fund and fairly big pool of capital to invest in fintech globally. And then we have raised our next fund also, which we closed Fund 8, which we closed in April this year. So it's closed a few months ago. And that's also 925 million, so almost $1 billion. So talking about funding winter, I think for the right VCs also, there's ample amount of capital to raise. Of course, this fundraise was harder, much harder than what we saw for Fund 7. But that doesn't mean that for the right ideas, for the right investors, there is not capital floating around. So as much as one would like to talk about funding winter, I want to assure you and I want to assure your listeners that for the right ideas, for the promising companies, for the promising founders, there's enough amount of capital around at early stage, at mid stage, at late stage, whatever stage you are in, right? But the important thing is for the right ideas and for the right companies, right? So, and we'll talk about what that means also in this weather and climate, so as to say.
Yeah.
In terms of what we are doing, we are a fintech focused venture capital fund. So we only invest in fintech, which traditionally would be some combination of financial services and technology companies that are serving financial services companies. Right? That's the gamut. So everything within banking, lending, insurance, asset management, and technology for supporting these businesses is within our spectrum. That's our sort of bread and butter, and that's what we have been investing in since 2007. We started in US, so we are a US centered fund. We expanded to LATAM probably around 2013, 2014. New Bank was famously one of our big early checks and a huge win for the fund. We always had some investments in UK because Nigel Morris, who's the managing partner, he's British. So he has his network. So we have been investing in UK for some time now. And then I joined the fund in 2020, and that's when we started expanding east of London, if you will, right, east of UK, looking at opportunities in Asia more importantly. So I cover our investments in Asia. Um, with me joining, it was sort of obvious that we first focused on India. I had a network in India to begin with, having worked in India with Flipkart and Truecaller before, but also kind of being close to the ecosystem, the founder sets, the VC sets that exist in the country. So we started with India. Now we have expanded to Southeast Asia. So we made some investments in Indonesia also. Overall, we have invested in 9 companies so far. Some of the names, as you mentioned earlier, those are big positions for us. We are on the investment board for most of those companies, so we are very significant. When we take position, we take a fairly significant position. We become important for the company that is important for us. And we are very optimistic, very excited about the prospects that India in particular offers, even within the global spectrum that we cover.
Okay, great brief, Sandeep. Uh, when you specifically speak about India and Indian market, have you made any maybe plan as such, or maybe do you have any target in mind that how many fintechs do you want to invest in 1 year? How much funds do you want to dilute in 1 year? Or what is your minimum investments going to be specifically when it comes to fintechs? And more importantly, any particular sector that you are going to be very aggressive on?
Yeah, look, Kamal, so we are quite meritocratic, and I say that not lightly. I'll give you a very concrete example of it. But because of being meritocratic, we don't really allocate capital top of the house by regions. We have never done that. We would never do it. The reason is we want the best ideas to win. So when I bring a company to the table, or one of my peer partners brings a company to the table, everyone looks at it as a set of opportunities globally, and then determines if this particular idea holds enough merit to warrant a check, right? And our checks are fairly significant at venture stage, which is Series A. We are primarily a Series A fund. We write checks between $3 and $20 million, and then we have a pool of capital for growth checks, which are between $20 and $40 million. So within QED, we can be a evergreen source of capital all the way to a pre-IPO stage for a company. So once we back an idea, we actually play the full 90 minutes. We go behind the company, we help them as much as we can all the way through, right? But because of that logic, because we are meritocratic and we can play multiple series, we don't really constrain capital by region, right? We actually look at the ideas on their individual merit and invest on back of it. The concrete example I would give you is if you have a new partner joining a fund, you would typically allocate a fairly meaningful chunk, small chunk of capital so that the partner can learn about the market and go after it. But if you look at our investments, the investments we have made in last 2.5 years, they're very significant. We have taken board positions, investor board positions in most of the companies you talked about, right? These are Series B, Series C, Series D companies in some instances, right? So we have deployed a fairly large chunk of capital. If you add up all our investments, that would be somewhere in the 150 to $200 million range, right? Among the total amount of capital we have committed already. So you won't, if we didn't like the merits of these ideas, we wouldn't have made these decisions, right? And vice versa, if we had gone just with a top-down allocation, then you wouldn't allocate so much capital to a new region in the first go around. So we genuinely like the ideas that we invested in. We genuinely see the merits of those ideas, and that's why we have gone and kind of gone in as deeply as we have.
Uh, just to add or maybe cross-check one thing, do you also take a board position in the companies that you invest, or you are okay, to be the companies to be run by the founders and the founders team itself, or you keen on taking a position?
We are so board is not a must for us. We don't ask for it. But typically, when QED invests, you would want QED to come on the board. See, every VC, I'm sure, says that they are different. The reason why QED is different is because we are all operators who became investors. I myself have worked in consumer technology and financial services for 20 years, for 2 full decades before I joined VC, right? And most of the partners that are around me who are in investing roles are of the same stature. They spent 20, 25, 30 years running businesses, right? I have run balance sheet businesses in the US. I've run balance sheet business here in the UK. India experience you already talked about. So we are operators at heart. So the advice we can offer would be quite different from what just a financial investor will bring to the table. Quite honestly, if you have not been an operator, you won't have the lens that a QED or an operator investor will bring to the table, right? So that's why when we invest into a company, the founders genuinely value our point of view, and they would find a way, they would invite us to join their board in some shape or form, right? So that's the honest truth of how things have happened. When I send term sheets, there's no condition saying that, hey, we have to have a board position, right?
Hmm. Noted your points, Sandeep. Quite meaningful one, in fact, because I have seen a lot of VCs or specifically investors look for such, important positions in the board, and not only that, but they will also ensure that they will try their best to, run the company according to their views as well. So that's also happening on one side. One thing I would like to really, I want you to highlight. I think that would be really interesting for our readers and specifically fintechs watching this show will be far meaningful is what are your parameters, Sandeep, when you choose any companies? I mean, why Jupiter and why not someone else, or why XYZ company and why not ABC? What
Yeah,
is that list? Perhaps if you could share, I promise you at least 1,000 people will knock your door immediately the next day.
please, they must knock my door. Look, so the number of criteria we use is quite a lot, but I'd focus on three main ones. Those
Great.
are sort of majority of the funnel, right? If you meet 100 companies, how many do you take to second meeting, third meeting, and so on and so forth? So top of the funnel is these three things. The
Mm,
first thing is what we call unit economics. Now
mm.
that term has become in vogue during funding winter a lot,
Yes, yes,
and it
yes.
gets thrown around a lot. But I want to highlight what unit economics means to us. Unit economics is being economically viable at the lowest unit of your activity, right? So what that means is if your activity is a single loan that you give out to customer, then probably that. But if your activity is keeping a customer and giving them repeated lending products, then that is your unit of activity. Or if your activity is an employer whose employees you're going to give earned wage access to, then that becomes a unit of activity. And I can give examples of each of the companies that I've invested in where these the meaning of the metric, the essence of the metric is the same, but what it really translates into is actually different in different contexts. But unit economics, being economically viable, is a precursor to being profitable, but is post facto of you having your product market fit and also having found people who will pay you more than it will take you to manufacture the product you're offering them, right? So it really is what we believe at the heart of being economically profitable in the long term. So unit economics is the first filter, right? And because you operate in financial services, very important metric, because say in e-commerce, and I worked in e-commerce companies, you can, let's say, spend millions of dollars attracting customers, and you'll then get some loyalty from them. They might still come back to your shop. They might come look at your products. But in financial services, you can give me any amount of capital. I can burn it up completely and have nothing to show for it. People will happily borrow your money and never pay you back, right? That's a fundamental possibility here. I can insure everything I want, and you can have any number of claims, and that capital base can completely get wiped out. So this is one place where being mindful of capital and being able to derive an economic return on that capital is very important, much more than I would say in any other part of technology ventures, right? So that's the first filter. Second filter is ability to scale exponentially. What do I mean by that, right? It's not just about using technology or having Google ads and Facebook ads to be able to scale your business. A
Mm,
lot of economically profitable businesses in financial services are offline,
mm.
right? Your neighborhood Sahukar was always a profitable business,
Right.
right? But it's not exponentially scalable for a lot of different reasons, some ethical, some regulatory, some consumer benefit, and so on and so forth. But for a lot of reasons, it's not an exponentially scalable business. So, in addition to being economically profitable, we are looking for businesses that have that potential where customers actually see so much good that they would advocate your product to the next customer. Where when you use a technological means to grow that product, it will have rewards that are far greater than what you reap by doing it otherwise, right? In some ways, it has a moat against offline businesses, other online businesses, which helps it grow exponentially in the long term. So being able to grow exponentially is the second metric that that we're looking for. The third thing, which is very important for us, is the founders that we're investing in. We have no see, in this business, you can apply as many structural filters as you want, but ultimately it's a people's business.
Right.
And in addition to the typical characteristics you want in entrepreneurs, which is drive and sort of being able to take a holistic sense of responsibility and etc., etc., we are very conscious that we operate either in financial services or in the neighborhood of financial services. So having founders who have an appreciation and understanding of uh, either being regulated or operating in the neighborhood of regulation, right, is very important. Founders that have a sense of what governance entails and what does it mean to not just do 0 to 1, but 1 to 10 and 10 to 100, and what that scale brings in terms of operating models, what it terms in terms of talent management, in terms of governance and control, is very important. And it's also very important to have founders who find value in investors also, right? Founders who are coachable, as we said, right? Founders are willing to listen, because see, starting your own company is a, as much as you have co-founders, it's a very solo journey, right? It's a very isolating journey, right? Because you are the sort of the motor that drives a lot of motion in your organization, among your customers, in your board. You're constantly powering everything. And at that time, it's helpful to have someone who will give you the voice of reason from a distance. It may not be the best informed voice, I have no doubts, right? You as founder probably know your company and your reality much better.
Right.
But I, as an investor, have a point of view which is a bit distant, bit removed. I can give you a perspective that you may not always have. So we want founders who would be willing to listen, right? It's all about listening. You can still make decisions that you want to make, but you want founders who will be willing to listen. So I would say those are three main filters. There's a number of other things that we look at, but frankly, these three are where sort of 90% of the funnel sits.
So I obviously copied your 3 points, and I'm sure they're quite useful, meaningful.
Hmm.
But tell me something, Sandeep. Does founders really listen, or they are like, I have a great idea, so I will not listen to anybody in the market? How's it? What is your experience?
So I'll go on a limb. I have 7 portfolio companies in India,
Uh-huh.
6 that we are very actively involved in,
Hmm.
right? All of those founders listen.
Okay.
They will seek out my advice when they think it's pertinent. There are topics on which my advice is not pertinent, and I'm very happy that they reach out to other VCs who are investors there who have a
Hmm.
better point of view on that. But on things that are pertinent, they all reach out to me and ask.
Okay. Okay. Uh, Let me take one or two more important questions. When we specifically speak about the funding winter, a
Hmm.
couple of investors told me that it's not only for the fintech companies to raise funds, which is getting critical, but also for investors, which is running funds. They are also being faced a lot of challenges by raising funds. So, like you said in the beginning, funding winter is quite real, and it's still happening. Right, we are in the midst of it.
Hmm.
So, giving this background, in fact, there was one more. I was just going through a couple of notes, and I understood that you made a nice statement maybe 2 to 3 months back that there will be few firms which will fail in next 6 to 8 months. Where are we today? I mean, from that 6 to 8 months, are you seeing a couple of firms failing? Are you seeing consolidation happening at a higher level? And if yes, what is going to be your strategy someday?
Yeah, look, I think so. Funding winter is very real,
Hmm.
and it's very real for VCs also. Because if you think about it from LP's perspective, LPs have an allocation between public and private, and then some geographical distribution. And so if the US public equities goes down and US public debt goes up, then your allocation changes. And even though Indian ecosystem is at a high in terms of FDI, it's still a very small percentage of the global investment pool, right?
Right.
So any small in proportion on one of these buckets can actually influence how much money is flowing
Hmm.
into India. Right now, we seem to be on the right side of all equations, but still there is a sensitivity. So raising money for VCs is both an issue of your own performance and what liquidity you can demonstrate and what returns you can ascribe to your existing investment, but it also is a function of sort of macro that is beyond their control, if you will. So the funding winter is very real at both stages. Look, I think the good thing that happened in India in 2021 when we were on the high side of the cycle was that founders were very prudent in not just raising for a 12 or 18-month runway, but they raised for 36, 48 months worth of runway.
Hmm.
Right? In US, especially what we saw is when the high was going on, a lot of founders still went in for a 12, 18-month runway. And then if they were able to raise more, they ramped up more initiatives to drive greater growth, commensurate with the amounts they had raised. So as a result, the regular cycle has then followed, right? At some point, the bad companies, the good companies and the bad companies ran out of money, and both sides had to come back to the market, and the pricing was getting reset. And so good companies are still getting financing, but at probably different terms than they would have seen in 2021. And then bad companies are not getting financing, and therefore there are sort of more instances of failures, more instances of acqui-hiring, more instances of acquisition, and so on and so forth, right? In India, the cycle has played out differently because founders raise more capital. That
Hmm.
means even sort of companies, in fact, all companies, right, still have a lot of runway left. They have not really run out of capital, right? So we started seeing some of those founders starting to come back to the market. And therefore,
Hmm.
you had a lot of news about companies being restructured, some fairly significant issues being identified in companies. It's not really fair for me to take names, but I mean, your own publication carries a lot of that news. So I'm sure you're well aware, which has happened over the last 6 months, right? A lot of those were instances that came across as not lack of funding, but were representative of things that happen under stress,
Hmm.
right? And not having enough funding is a form of stress on organizations. So I think that process of cleanup, right, which sort of got postponed out of 2021, right?
Hmm.
Because the way this ecosystem works is 100
Yeah.
companies get formed, a certain percentage of them fail every year. And so
Hmm.
it's the survival of the fittest, if you will, right?
Hmm.
And in 2021, everyone got a huge shot of steroids in their arms, right? So everyone lived for 2 more years. But we will see some of that go away because if those companies are not fundamentally healthy, if they don't find product market fit, if they don't create economic profitability, then they won't become viable enterprises. So at some point, gravity will catch up with them, right? So we'll see that phenomena happen. Also, I guess worth calling out that with the funding winter, VCs and kind of so early stage VCs, mid stage, late stage VCs have all become cautious about what they are financing,
Hmm.
right? So there's the bar has gone up for everyone, and that will also catch a lot more of not so great cases in the times to come.
Okay. So when specifically you add that the for VCs the bar has gone up significantly, um, what does that mean? I mean, if you could add more here in terms of they're adding more filters, they are doing due diligence far more than what they used to do earlier, or if we put it very simply, the tap which was flowing water bucket after bucket is being closed now.
Yeah, so what's the best way to answer that? The answer is very heterogeneous, right? It's a sum of all the points you mentioned. The answer is very heterogeneous. Let me touch upon the more relevant and positive things, which will be more useful for your audiences,
Hmm.
right? See, concrete illustration of bar has gone up is terms like unit economics, terms like profitability
Hmm.
are not just relegated to one slide in the deck,
Hmm.
right? They are forefront in the pitch, especially when it comes to fintech pitches. That's one of the first few things that founders will pitch to us, which
Hmm.
means it's not just us who's pushing for this, who has been asking for this. Every other VC around the house is asking for these things,
Hmm.
right? And if founders are talking a lot more about it, then one hopes that they're also thinking a lot more about it. They are, in fact, right? If you look at Twitter and the kind of tweets that have been coming out, a lot of companies are turning profitable, having their first month of profitability, first quarter of profitability, etc., etc., etc. So the focus on profitability is a very clear example of bar getting raised,
Hmm.
right? Another big example you would say is governance standards and how companies are run, right? Like how tightly do kind of investors like us ask companies to follow the word. What has happened to companies that were in the gray area,
Hmm.
regulatory gray area, that has created examples for others to then be more prudent
Hmm.
about and more mindful of what's happening around the world, or
Hmm.
is an example of where the bar has gone up. I think bar has gone up also in terms of talent and recruitment, right? There was a time when you used to get, I mean, the competition had just gone through the roof, right? It was ridiculous, doesn't even capture it how high it had ratcheted up. And a lot of that has normalized in the ecosystem. Performance expectations have gone up from employees, but also from leadership teams, from founders themselves. I think that's another example of what you can produce with every dollar that I give you, right? Productivity, if you want to measure it that way, then the bar on productivity has gone up. So those are a few examples, but yeah, I hope they illustrate the point.
Yeah, I think you made a great sense there, Sandeep. So let me shoot my last question here, and maybe if we can conclude there. So, Sandeep, my important question now is, if you read all the reports, specifically India has been emerging as a bright spot, is what every global agency is saying. We have a number of fintechs coming up with greater solution. In fact, I have seen rally shifting from payment to credit to now health tech and insure tech, right? But again, few of them are also struggling to raise funds. One interesting thing that also happened in last couple of months is regulators have also become very active and they're very sharp. They're looking
Mm.
at the movements of each and every fintech operating in couple of spaces like credit. Given this background, Sandeep, what is your outlook? How positive are you still when it comes to investment? Will you go heavily onto investments, or will you go very slow, wait and watch how the situation is, whether the situation will change, and maybe you will, what you can say, open your bucket when the season is changed? How is it going
Yeah.
to be?
Look, I think we are thoughtful and mindful among all the investor pools out there, but words can't capture how excited we are about Indian market, right? For many different reasons that you called out, but I call upon three, which are the most important, which are the top of my investment thesis for India, right? I think the macro for India, I mean, it just shines. Shines doesn't capture it. It outshines everything else in the world right now. Not just GDP growth rate, but where the GDP is, how fast it's growing, the disposable income, rise of middle class. I could go on and on about how many positive macroeconomic, and these are real objective numbers. I'm not talking about subjective numbers. These are real objective numbers that anyone with a sense of numbers can now evaluate and look at it. I think the second part about India's story, which is very exciting, is actually something you touched upon, which was on the kind of financial services and regulatory side of it. From financial services perspective, India has had a very long legacy of very professionally run financial services companies for a long time. Even the state banks, so as to say, of today were actually private institutions that were started, and they retain some of that professional cadre in terms of how they serve, how they operate. It's no surprise when you go around the world, a large chunk of middle and senior bankers are of Indian origin, right? India has had a very long history. On the regulatory side, I take a quite different view from other VCs because we come from operatorship background. We understand what it means to operate regulated businesses, and in fact, we appreciate some aspects of it. See, if you're running an e-commerce business, you have to spend millions of dollars to win loyalty and trust of your customers. Right? I'm taking e-commerce because that's usually the first wave of internet businesses in any country. So you usually have to spend millions of dollars to earn your customers' trust and loyalty. Whereas in a regulated field, if you get a license, that to your customers is a statement that now someone with a deep perspective on the sector trusts you to run a proper business, right? It's a mark of trust that you have earned by just getting a license. It's very hard to get a license, right? I have no qualms about it, but getting the license is worth millions of dollars worth of marketing spend over a number of years, right? If not more. So being regulated and having a regulator like RBI who's actually trying to shape the ecosystem, not just to reach macro objectives, but also to drive innovation is fantastic. There are very few countries where you would have this happy sort of marriage. And it's not a smooth journey. I have seen the journey over the last 8 months. It's not a smooth journey, but it's a journey in the right direction. And it's a journey with the right initiative. And that you can't take for granted, right? So that's the second factor. The third factor why I'm ecstatic about India is on the talent dimension of it, right? Most countries would either have a paucity of talent or would have bias set of talent. I'm holding US on the side because US just has a phenomenal depth of innovation going back. But India has a depth of talent on both technology and financial services side. Going back to TCS and Infosys days, right? Tech services has been a big part of Indian industry for a long time, and over time that has grown into product technology, and technology pure play talent, even deep tech talent in many shapes and forms. So India has a phenomenal depth of technology talent. I'm not talking about how many graduates come out a year. I'm talking about the few hundreds and thousands of engineers that you need, which are very high caliber. If you start with a larger base, it will just be easier for you to get to that number. Statistics works in your favor in this regard. The second part of talent that's very exciting, as I said, is the banking talent. Right, India has a very well set of trained bankers, and fintech is a confluence of these two talent pools, if you will. Right, so India is the Triveni, right, where you really want to be, where all these factors meet, right? Where you have phenomenally good macro, phenomenally good sector dynamics, and phenomenally good set of talent coming together. There couldn't be a better place to invest.
Noted your point, Sandeep, and that was quite thoughtful, I must say. Couple of meaningful thoughts there. I'm sure the people, those who are watching this particular show, will not only understand the QED investment strategy in terms of how do you invest and evaluate fintechs, but also, why are you so bullish and your outlook specifically on the Indian market. Thanks so much for your time, Sandeep, and sharing all these thoughts at FinTech Diary on etbfsi.com. Thank you so much.
Yeah, and thank you so much for having me.